So for the part 2, problem 1 question, we had 3 different projects, and using different approaches, you had to select the best project. So for the questions A and B, the task was to calculate the return on capital employed and the payback period. So to find the return on capital employed using the average capital investments approach, you have to first find the profits. So average cash flows are given as $10, but cash flows, they don't include depreciation, whereas profits include, which means that you have to find the depreciation expense and then subtract depreciation expense from cash flows to find the profits. So how do you find the depreciation expense? You have the initial investments of $50, we have scrap value of $5, and the depreciation expense is the initial investments minus scrap value divided by duration of the project, which is 8 years. So basically, in this case, 50 minus 5 divided by 8 gives us $5.63 is annual depreciation expense. So profits are $10 minus $5.63, which gives us $4.38 of profit for each year. So to find the average capital investments, which is denominator of return on capital employed, you take the initial value, add scrap value, and divide by 2. So which is 50 plus 5 divided by 2, giving us 27.5. For return on capital employed, we take this profit number 4.38 and divide it by $27.5, which gives us $15.91. So next is to find the payback period. In this case, the cash flows are constant, which means that every year we have similar cash flows, and you just divide initial investments by cash flows, which is 10. 50 divided by 10 gives us 5 years. And the same for project B and C. In every case, you find the depreciation expense, then subtract depreciation expense from cash flows to find the profit number, and find the average capital investments, which are calculated as initial investments plus scrap value divided by duration of the divided by 2. And for say, you just divide this average profit number by average capital investments. In this case, it's 16.07. And for payback period, we just divide initial investments by average cash flows, because cash flows are similar for every year, same for every year. And for project C, the approach is also to find the profit, find the average capital investments, find the return on capital employed, which is 33.33, and find the payback period, which is $60 divided by $20, giving us 3 years of payback period. So how do we choose between the projects? As you can see, ROCE is 16% for the first project, 16% for the second project, and 33% for the third project. And in order to find the best project to invest in using return on capital employed, we find the highest capital employed, which is 33.33% in this case for project C. And for the payback period, you have to find the project with the shortest payback period. In this case, we have 5-year payback period for project A, 4.67 years for project B, and 3 years of payback period for project C. So the shortest period is for project C, which means that you have to take project C using payback period approach. So the next step was to calculate the net present value for these 3 projects. Net present value takes into account the cash flows. Cash flows are given as $10 per year for 8 years for project A, but you also have to add scrap value in your calculations, because you're going to receive scrap value at the end of useful life. So scrap value of $5 in year 8 is added in our calculations. So net cash flow is a sum of annual cash flows and scrap value. So minus $50 of initial investments, $10 for first 7 years, and $15 for 8th year. For discounted cash flow, you gotta discount every cash flow by by a proper discount period. So for the first year, we discount by year 1, basically 10 divided by 1.1 in the power of 1, 10 divided by 1.1 in the power of 2, and similar for years 3, 4, 5, 6, 7, and 8. So NPV is the sum of discounted cash flows, which is 5.68 in this case, and the same for project B. You just take all the cash flows, and for the last year of operation, you add disposal value. Then we find the net cash flow, which is given as sum of all the cash flows occurring at that year. So minus 70 for the first year, 15 for the second, for the first, second, third, fourth years, and $25 for the 7th year, because you're going to sell this asset and receive some money in return. And discounted cash flow is given as net cash flow divided by 1.1 in the power of 2 for the first year cash flow, and the same for all the following cash flows. NPV is sum of all discounted cash flows. In this case, gives us $8. And same calculations for project C, and NPV is calculated as $31. So using NPV approach, if these projects are mutually exclusive, meaning that if you undertake one of them, you cannot undertake the second or the third one, you have to find the NPV with the highest number, project with the highest NPV. So the first one gives us $6, second project gives us $8, and the third project gives us $31, which means that the favorable project would be project C. And the last task was to calculate the profitability index, and also choose project, assuming that projects are indivisible, which means that profitability index is not applicable. So in first case, when projects are divisible, you can calculate NPV's initial investments separately and then find the profitability index, which is given as NPV divided by initial investments. So NPV is calculated in question C. You just take this number of 5.68 divided by initial investments of 50, which gives us 0.11. And for the project B, it's 0.12, and for project C, 0.52. So basically, you have to rank them in correct order, starting for the highest number, which is 0.52. Second one is 0.12, and the third one is 0.11. And you have these initial investments of 60 and 70 for the projects B and C, which gives you 130 in sum, and the capital was limited to 130, which means that you cannot take projects anymore. So for divisible project, you have to select projects C and B if capital is limited. And the next approach is to assume that projects are indivisible, which means that there is no need to calculate the profitability index, but you have to try to undertake different projects not exceeding $130 value and find the project with highest NPV. So which combination gives us the highest NPV? In this case, the highest NPV is given by this $39.21, which is undertaking projects B and C with investments of $130. So the answer is to choose projects C and B. For the problem 2 of part 2, the first task was to calculate the tax savings. So tax savings are given as depreciation expense multiplied by tax rate. So how do you find the depreciation expense for this task? You find the initial value of $500,000 and find the useful life, which is given as 4 years, and disposal value of $50,000. You just subtract disposal value from the initial investments and divide by useful life of 4 years. So depreciation expense is given as $112,000 and $112,500. So the same for every year, because we are applying a straight line depreciation method in this case, and tax savings are given as 10% of this depreciation expense. So just multiply by 30% for the second, third, fourth years. So total tax savings are given as sum of all 4 years, which is $33,75,000 for 4 years, in sum giving us $135,000. So for question 2, you have to find the NPV of this project, which means that we are taking, so we have to find all the revenues, related costs, and subtract initial investment to find if this project worth undertaking or not. So demand is given as stable $10,000 for 4 years, and price per unit is given as $40 in current terms, which means that in year 0, but we are starting operations and starting selling in year 1, which means that for first year you already have to include the inflation of 4%. So $40 multiplied by 1.4 gives us $42 rounded. And same for the second year, you just multiply the first year price by 1.02. And for the third year, you multiply 43% by 1.4. So you just include inflation to find the price per unit at that year. So revenue is calculated as demand. So demand is number of units sold multiplied by price per unit, which is 42. So the revenue is calculated for the first year, second years in the same way, just demand multiplied by price per unit. So next step is to calculate related costs. In this example, we have both variable costs and the fixed costs. So variable costs are given per unit. Per unit means that you have to first calculate the variable costs, take into account the inflation, and then multiply them by demand, which is given in the first row of $10,000. So variable costs are given as $15 for the in today's terms, which means that in the first year of operations, they're going to turn into 15 multiplied by 1.04 multiplied by 15, which gives us $16, and for rounded. So for the second year, you multiply first year figure by 1.04, and for the third year, you multiply second year figure by 1.04, and same for the fourth year. So to find the total variable cost, you multiply variable cost per unit by number of units sold. So 16 multiplied by $10,000. In this case, 16 multiplied by $10,000, but note that these numbers are rounded. In fact, this is less than 16, and this number is more than 16. So contribution is the difference between revenue and variable cost. So in this case, it's not necessary to conclude, but I've just included to show that the intermediate result. So revenue minus variable cost in this case for the first year is $260,000, and the same calculation applies for second, third, fourth year of operations. You just subtract variable cost from revenue. And to find the fixed costs, you don't find them, actually they're given. So we just take the fixed costs. They're given not for per unit, but total number is already given. There is no need to calculate anything because they're fixed, and there is no need to adjust them for inflation. So fixed costs are given as $100,000 for every year for 4 years. And so taxable cash flow is the difference between this contribution and fixed cost. So basically, taxable cash flow is revenue minus fixed cost minus variable costs. In this case, taxable cash flow for the first year is $160,000 for the first year, $170 for the second year, $180 for the third, and $190 for the fourth year of operations. So tax is paid in arrears, which means that if you sell the items during the first year operations, you pay the taxes at the end of the second operations. So tax is 30%. You multiply this $160,000 by 30% to find the first tax payable. So tax expense is $48,000 for the second year. For the third year's calculation is the same. You just multiply second year cash flow by 30% tax rate, and the same applies for fourth and fifth year of operations. So you can know that for the fifth year of operations, we don't have taxable income, but we have tax expense because tax is paid in arrears. You sell during the fourth year of operations and pay taxes 1 year after that during the after fifth year of operations. So next is after calculating operating profit, you have to include all the relevant cash flows, which are initial investments, working capitals, and scrap value. So initial investments are given as $500,000 for the first year. Working capital investments are given as $50,000 for the first year of operations. But as you know, we include not the working capital itself, but the working capital investments. So basically, you invest $50,000 during the at the start of the operations, and at the end of the operations, which is fourth year, you're going to receive it back. So plus $50,000. And the scrap value is also given as 10% of the initial investment. So $50,000 at the end of the fourth year. And the net cash flow is the sum of all relevant cash flows. So operating profit plus initial investments plus working capital plus scrap value. So for the for the first year, we take taxable income, we take tax and all the relevant costs. For the second year, we take $170,000 of taxable cash flow minus tax, and we don't have any investments, as you see. Same for the second year. And at the last year of operations, we have positive operating profit minus taxes plus working capital plus scrap value. And during the fifth year of operations, we only have tax to pay. So number is negative. And discounted cash flow is just this net cash flow divided by 1.1 at the power of 1 for the first year and the power of 2 for the second year cash flow and the power of 3 for the third year of operations, and same for fourth and fifth years of operations. So net cash flow is a sum of all discounted cash flows, which gives us minus $78,800. So the number is negative, which means that we don't accept the project because NPV is less than 0. And the last part of problem 2 was to calculate the optimal replacement cycle. So for optimal replacement cycle, you have to find equivalent annual cost and compare them between different options. So the first option was to replace the asset after the fourth year of operations, or second option was to replace the asset after the fifth year of operations. And as you know, our fixed costs and the so scrap values change for every option. So for the first option, you have to calculate the initial value and minus $100,000 fixed cost for 4 years. And for the last year, you also include the scrap value. So for this question, it's minus $100,000 plus $500,000, which gives us minus $500,000. So you discount them by appropriate discount period and find the sum of all cash flows. So in this case, sum of all cash flows is $780,000, and then find the discount factor. So this seems complicated, but in fact it's not. So if you have 4 years, you have to sum up 4 discount factors. So first year discount factor is 1 divided by 1.1. Second year discount factor is 1 divided by 1.1 in the power of 2. Third year discount factor is 1 divided by 1.1 in the power of 3. And fourth year discount factor is 1 divided by 1.1 in the power of 4. So equivalent annual cost is sum of relevant costs divided by discount factor. In this case, equivalent annual cost is equal to 246 or $47,000. And the same for the second option. Fixed cost of $100,000 is given for 5 years. And for the last year, we have disposal value of $50,000 of initial investments multiplied by 7%. So basically, you have minus $65 outflow on the 5th year of operations. Then you discount all the cash flows and find the sum of discounted cash flows, find the discount factor. So for the second option, discount factor is higher number because you have to also include the 5th year discount factor, which is given as 1 divided by 1.1 in the power of 5. So equivalent annual cost is given as sum of PV divided by discount factor. So you compare these two numbers, it's obvious that the second option gives us lower equivalent annual cost. So lower cost means higher value. So we choose to replace asset after 5th of a year of operations, which is option 2. For the third problem of part 2, the task was to calculate the relevant ratios and to provide the interpretations of those ratios. In these solutions, I didn't give the interpretations, but calculations. And if you want to see the interpretations, you can refer to the textbook. So to find the return on capital employed, the formula is and the earnings before interest and tax divided by capital employed. So earnings before interest and tax is the same as operating profit and is given as $440. And then we divide them by capital employed. So capital employed is total assets minus current liability. So in this case, total assets are given as $2,200 minus current liabilities of $220. So the result is 22.22%. The same for year 2022. You just take earnings before interest and tax, divide them by total assets minus current liabilities. So return on equity is calculated as net income divided by equity. So net income is given as 285. We divide this number by equity, which is $1,500. So the result is 19%. The same for the 2022 number. You divide this 300 number by 1,500 number. So the result is $20, 20%. Next one is to find the margins. So you can find any margin as you prefer. So either gross profit margin, operating margin, or net profit margin. So here we have net profit margin and the gross profit margin. Gross profit margin is calculated as gross profit divided by revenue. So basically we have this $950 divided by 2,500 number. And same for the next year. And for net profit margin, you divide net income by revenue. For question 2, the first ratio to calculate is interest cover. So the formula is earning before interest and tax divided by interest expense. But you have to know that interest expense is given as minus sign, so I've included minus in our calculation to show that interest cover is given as a positive number. So interest cover cannot be negative. You have to include expenses as cost without its sign. So 440 divided by 60 gives us 7.33%. And debt to equity is ratio of debt, which is 700 divided by equity, which is $1,500. So the result is 0.47 or 47%, which means that relation of debt to equity. Next is investor ratios versus earning per share. So earning per share is given as earnings or net income. So net income of 285 divided by shares, number of shares. So in this case, 1,500. So the result is $0.19 per share. So next one is price per earning. Price is given in the task as $10, and then you divide them by earning per share as you've calculated in the first step, so 0.19. In this case, 10 divided by 0.19 gives us 52.63%. And the last is interest cover. Interest cover is given as net income divided by ordinary dividends. So ordinary dividends are total amount of dividends paid, not for the share. So dividend cover in this case, 3.56, almost 4 for the first year of operations and 3.33 for the second year of operations.